Hi, I'm Gaalen Engen for Equity.Guru, and I'm here to talk to you about options trading. So what are options? Options are publicly traded securities known as derivatives. What's a derivative? Well, it's basically paper traded over top of an underlying asset. Commodities such as gold, or let's say equities such as shares in a company like Microsoft, or let's say exchange rates or interest rates. The possibilities are nearly limitless, so why don't we just stick to shares for right now to keep it simple. Options have an advantage over trading in the asset itself due to two things known as leverage as well as limited risk. When you trade stocks, you typically trade at a 1-to-1 ratio, or at most maybe 3-to-1. When you enter into an options agreement, the premium you pay for the contract is at a significant discount to the market value of the underlying asset. An option contract also has limited risk, meaning that if your investment goes south, the most you're going to lose is the premium you paid for that contract. There are two basic types of options contracts: a call option or long, where you have the right to purchase the underlying asset at a set or strike price on or before a specific expiry date. Then you have the put option or short, where you have the right to sell the underlying asset at a set or strike price on or before a specific expiry date. In the case of calls, if I buy an option contract for 100 Microsoft shares with a strike price of $290 and the company currently trades at $282, I could end up paying a premium of approximately $8 per share for that contract. So that's $800 total, compared to the $28,200 I would have to pay for those same shares on the open market. My hope is that the market value is going to rise above my strike price on or before the expiry date. Let's just say it rises to $300 per share. I now have the option to buy those shares at $290 a share, giving me a profit of $10 per share minus the $8 premium per share that I paid, for a total profit of $2 per share or $200 for the contract. In the case of puts, let's just use that Microsoft example again. Except this time my strike price is $270. That means I would pay approximately $12 per share or $1,200 total for that contract. Now this time my hope is that the market value of that share will drop below my strike price on or before the expiry date. Now let's just say it drops to $250. This means I now have the right to sell those shares at $270. For a profit of $20 per share minus the $12 per share premium I paid, giving me a profit of $8 per share or $800 for that contract. As stated before, if my option is out of the money or unprofitable, meaning my investment didn't go the way I wanted, the most I will lose is the premium I paid for that contract. Sounds easy? Well, it isn't. Not only do you have to gauge whether or not the price will go above or below a specific price, you also have to guarantee that it's going to happen within the specific time period of your options contract. There are also a myriad of factors that go into determining an options premium price, its profitability, and its attractiveness. So if you're unfamiliar with terms like delta, time value, implied and historical volatility, or hedging, maybe you should stick with stocks and ETFs right now and get your feet wet under the tutelage of an investment professional before you jump into the deep end of options trading. So that's it. And that's only a basic breakdown, but I hope I've given you a better understanding. If you want to learn more about markets, stocks, and trading, you can join our channel or you can come to our website, Equity.Guru, and join our family.